For every investor who makes money from real estate, there are countless others who crash and burn. Now, I've been investing in real estate for the last 36 years, and I've seen the good, the bad, and the ugly. So in this video, I'm going to talk about the 7 mistakes that amateurs make in real estate that practically guarantee that you're going to lose money. Now, this may not be what you want to hear, but it's going to be the truth. And if you watch this all the way to the end, I can guarantee you one thing, you'll be smarter than when you started. So let's get to it. Number 1, the lack of solid market information and data. The number 1 reason most amateur investors lose money is they simply don't know what they're doing. And to make matters even worse, they don't realize how much they don't know. Now, what do I mean by that? Look, you just don't buy a property and suddenly start becoming rich. The most important step in investing is to learn the market. Now, amateur investors, they don't research the local area. They don't study the recent sales. They have no clue on how to get the property a true value of that property with the highest and best use of what that property can be. You can't just rely on Zillow data or what your cousin's best friend thinks about the house is worth, because guessing is not investing. That's speculating. Look, it's not the lottery where you buy a ticket and you hope for the best. You need to know exactly what properties are selling for in that area and how much they'll rent for and how long they sit vacant, and how neighborhoods are trending, and what's the upside, and also, more importantly, what's the downside. You need to know if it's a growing area, or is the population stable, or are jobs coming in, or are they leaving? So it doesn't stop there. Understanding how to value a property properly is super important. So when you buy a house as an investor, it's most likely that it's going to need some repairs or some updates done. So you need to know the difference between the price of that property, what you can buy it at, and the price of it after the repairs are done. And what's the highest and best use of those resources and that particular property. So for example, let's say you buy an old house for $300,000 and it's an investment, but it also can be a liability. So let me explain. Now, let's say that you want to flip it and you're going to use that for rental income. Now, you probably have to do some repairs like HVAC replacements, roof repairs, plumbing issues. And that's how, when you flip it, you're going to make your profit. So you also have to consider the estimated repair costs on how much you'll be able to sell it for if flipping is your game. But since it's an old house, maintenance costs are always a bigger and higher than usual, right? Because what are those maintenance costs? How fast can you sell that house? And really, how long is it going to sit on the market? And what will those costs be by the time you sell it? That's the important stuff. How many months can you afford a negative cash flow? Does this make sense? So you also have to think about taxes, insurance, HOA fees, and all the other stuff like that. And that's why before you even step on the market, you learn to read sold data, the rent comps, and days on the market. Now, you also want to talk to local agents, but the true real estate experts and the appraisers and property managers. You want to drive through those neighborhoods in the morning, in the midday, and in the evening. You want to walk through properties. Now, this is a huge, very big subject, and you're not going to go to school and take a basic real estate finance course to learn this stuff. You just really need to weigh the good, the bad, and the ugly, because you're not going to master all these skills in one day. I didn't, and you're not either. You just need to know them. And you need to avoid the costly pitfalls. But after doing this for 36 years, it does get easier to spot those hidden gems and to avoid the pitfalls that are costly. So let's go to number 2, bad financial planning. Now, when a new investor gets a deal under contract, in most cases, they don't have a financial backup plan. There's no strategy and there's not even a backup. So like I said, you have to worry about vacancy periods. You have to worry about major repairs, property management fees, legal issues, and HOA fees, and rising insurance costs, and the list keeps going on and on. And these are essential costs that new investors don't even consider when they're running their numbers. It's the stuff that'll hit you in the back of the head, though. It's like, don't worry about it. But here's the thing. What if things go wrong? This is important. In real estate, things will always go wrong. Pipes burst, tenants leave, roofs leak. And if you didn't plan for that, that's catastrophic failure. And then it comes to the killer. Over leverage. Now, a lot of new investors, they get excited when they get a deal for 10% or 15% or 25% down, but they don't realize that it's an investment loan that comes with a whole different set of rules. You don't get the same flexibility as a primary residence loan because lenders know the risk is higher. Now, if the property doesn't cash flow like it expected, and it rarely does, especially in the beginning, that is, you end up dipping into personal savings and just to keep this thing going. And that's how things will spiral out of control. And that is called a loss, not a profit. So instead, before you buy, make sure you have a solid plan. You need to factor in every cost. Property management, even if you self-manage, there's costs. Ongoing maintenance, the HOA fees, the fines, material cost prices and things that increase. And typically, you need to build a reserve fund that you're going to cover for 3 to 6 months of expenses. Now, most importantly, your break-even point. You need to know what this is. You need to know how far rents can drop before you're negative. And that number should be your guide in every decision you make. Number 3 is inadequate due diligence. Now, this is how you walk straight into a nice disaster. People get too excited, they skip the real deal inspection, or they trust whatever the seller tells them without verifying. So some don't even check the title history or the history of that property, and then discover old buried gas or oil tanks on the property that can quickly derail a real estate deal due to hazardous materials leaking into the ground, and there's costly remediation and really the legal liabilities. Now, another mistake is inheriting tenants without properly screening them. You bought a property, tenants are there with it. The problem is you don't know who these people are, and you might have been lied to by the seller for a reason. You may not even know that they really don't pay on time, or if they have a lease, or if they're legally even right to be there. And then suddenly your new landlord stuck with a non-paying tenant. So let's go to number 4, which is underestimating risks. Now, one misconception is new investors that real estate always goes up. It doesn't. This is true. Real estate goes up over long periods of time, but not always. And yes, real estate values do tend to rise over the long term. This is why more people have made money in real estate than any other investment. But if you look at national data over the last 10 years, you'll see home prices, sure, they've gone up. But that doesn't always mean that it's always up, and away in every neighborhood all the time. That's because real estate is hyper local. Now, I've said this before in other videos here on this channel, but what's happening in one neighborhood doesn't necessarily reflect what's happening in a city next door or in another neighborhood or the rest of the country. Now, even if there's a national shift, it can impact, and it's going to vary by region. One side of town could be completely different than the other. Now, some areas will barely feel anything going on, while others might see the significant decline. So don't always take this guaranteed, but here's where amateurs really do get blindsided. They don't account for risks. They just assume everything's going to go well. The truth is, market's correct. Tenants may not pay rents. Cities pass laws that turn your short-term rental into an illegal operation overnight. Now, this isn't anything new. It's been happening for years. You just need to look at where the upside potential is and compare it to the downside. And amateurs usually don't check for that local eviction law or flood zones or insurance risks, or look into city development plans, or consider how many things can change in that local market. Now, it's important to keep in mind that real estate changes. Just it does. And it happens relatively slowly on national levels. This isn't the stock market where it just crashes or it jumps overnight. Most of the time, it's slow and steady, one direction or the other. So when you look at the data, that 2008 mortgage meltdown crash, it took years for the market to fully correct itself, as you can see here. Now, from 2002 to 2006, prices kept rising year after year. But then around 2007 and 2008, the market started to turn. But even then, the prices didn't just fall off a cliff overnight, right? It took till 2009-11 for prices to really hit the bottom. And that means it took about 3 to 4 years for the mortgage meltdown to fully play out. Now, as we see here in 2025, you can see the second chart that we have data until 2024, fourth quarter. But after the pandemic in 2020, prices really shot up, mostly because of low interest rates and low inventory at the very same time. But then starting around early 2023, the growth stopped as interest rates started to rise and affordability got tighter for some buyers. And price growth, it slowed down. In fact, some markets, it dipped a little bit. Now, as I explained in my market crash possibility video here on this channel, this isn't a crash. It's more of a plateau, depending on where you're looking and what state and even what city. But when it comes down to the local level, like a neighborhood, it can be a totally different scenario because local markets, they can shift pretty fast. Now, if you're all in just one area and something changes there, like a big employer shuts down, you can see what happens. How about a flood zone change? It can affect the entire market of that small area. So this means that if you have all your money in one neighborhood or one market and something goes wrong, your whole investment is explosive. And this brings us to the next point, which is number 5, lack of diversification. Now, putting all your eggs in one basket. You've heard that before, right? Is any of this helpful so far? Give me a thumbs up. So here's where it is. It usually starts like this. They save up, you finally get enough to buy a rental, and then they go all in. And all of the capital is tied up in 1, maybe 2 properties, and then they're overexposed. Now, think about the risk here. And if that neighborhood starts to decline, their investment sinks with it. And here's why, if you're holding on to the long term, it's better to diversify your investments. Different locations, different property types, even different income models. And you can have a mix of long-term rentals and possibly short-term unit if the local laws support that. But if you want to start to put a house on an Airbnb, you want to watch this video, and I'm going to leave it in the description below. The point is, no single issue should be able to take down your whole portfolio. And number 6 is emotional decisions. Now, this is what destroys new investors more than anything else. They fall in love. They fell in love with the idea of being a real estate investor, or they fell in love with a particular property. They just love it. They watch a few success stories, a few videos on TikTok, and they start thinking, man, I can do that too. And they see that property, and they're convinced this is a great investment. And sometimes getting emotionally attached to a deal just because they've already spent time on it and can't see the light besides that one or anything else, right? Or they buy into a so-called hot market because everyone else is doing it, everybody's talking about it. This can be a dangerous situation. And you know what they say, buy when they're selling and sell when they're buying, right? When they say it's a terrible time to buy, what does that really mean? Look, real estate is a numbers game. If the numbers don't work, the deal isn't right. You have to ask yourself these questions. What's the exit strategy? What happens if the home values drop by 20%? What if the rents go down? What is the upside to this property? What is the highest and best use of this property, or even the land that it sits on? Because there may be more than one way to make money off of that particular property. And also, would you buy this deal again if it wasn't already that I had so much time and emotion invested in it? Which leads us to number 7. Is time and management mistakes. Now, one of the biggest myths in real estate is the idea of passive income. It's great. Sounds great on paper, but when you buy a property and you hand it off to somebody and just collect checks every month, just remember something. Someone else is doing that work, and you're probably putting less money in your pocket as the investor because you got to hand that off. This is so true, especially if you're starting out. It takes a lot of hustle. And real estate, just realize this, it is a business. It's like any business. It takes time, attention, and effort to run it properly. Now, just remember, if you're managing everything by yourself, it's a job to deal with tenant complaints, repairs, vacancy, all that stuff falls on your shoulders. But that's where your profit can be as well. And if you do decide to outsource, of course, they're going to charge money for this, right? So if your deal is already tight on cash flow, you won't make much sense in hiring a manager. But if you're doing all that work yourself, all that work, all that income goes straight to the bottom line. But realize you may end up doing all the work yourself anyway. So here's the big question. Why is it that 99% of amateur investors lose money? Why? Because they treat real estate like it's a magic cash machine. Fact is, 90% of all millionaires have become one through owning real estate. And it's a fact that real estate has created more millionaires than any other vehicle. But there's also the fact that many rookies get overconfident, cocky, and they're unprepared, and they invest emotionally. They fall in love. Just realize real estate is a business. It requires a strategy, market knowledge, and operational skills. If you don't have all 3 of those things, the odds are you're going to lose money. Now, if you're serious about doing this the right way, hit that subscribe button because I'm here to help you avoid the pitfalls that are costly. My name is Jerry with Jerry Pinkas Real Estate Experts. If you're thinking about buying or selling property here in Myrtle Beach, South Carolina, or anywhere else in the United States, we can hook you up with that local real estate expert. Just give us a call at 843-839-9870. My real estate team is here to help you find that hidden gem and avoid those pitfalls that are costly. So until next time, stay happy, stay educated, and I'll talk to you soon.